At some point in your trading journey, you will be introduced to derivatives. Once in, there is no coming back from that place. Though you may fall 100 times, taming this monster is more fun than continuing playing in the status quo. In derivatives, the monster comes as variables. Understanding the story each variable trying to tell us becomes our routine. If understanding of the spot market involves 10 variables, then the derivative market will throw 100 variables at us to decide. Though a wild generalization, the core idea remains the same. When you are dealing in equity segment of the market via buying and selling stocks, shorting stocks, at the end the primary asset is still equity, which is nearly perpetual at least in the nearby horizon. The chances of a good stock turning completely into zero in value is very uncommon and remote. In case of derivatives, future behaves nearly in the same light. But when the object in the question is an option, this dimension changes. Options, unlike future, is a second order financial derivative which has a complex relationship with the underlying asset. The nuances of options are not the focus of this class. The reader is expected to have a complete fundamental understanding of options before you watch further. An option chain is a tabular data reporting done by exchanges to show what is happening to option derivatives in available expiries. In most exchanges around the world, this data is freely available. Though there may be reporting delays, most market offers this report free of cost in their live report sessions or related sections. In certain market, though report not available, you would have to create a report in your trading system. It is time consuming to select different strikes and parameters, but once you're done, it can give you a comprehensive view of the market than most technical analysis tools if you are able to read and understand the stories these numbers are telling. I prefer the second method of creating option chain as the reported data is fresher. Then there are third party apps or analytical tool providers who may charge you another subscription fee to see this in a more visually appealing and understandable way. But in long run, if you are able to tell the story on your own from these tables, the better. The app gimmicks would not fetch you anything more than a false sense of security. This class is purely prepared for option traders, and if you are an investor watching this, you can at times check the option chain to determine whether your portfolio needs hedging in short term or not. Such nuanced decision can be accurately done with the help of option chains. And as a final note, before we start the class, any amount of new novel information in the market is useful. Sometimes things we read or learn would not make any sense right away, but in later stages of our trading journey or investing journey, this subtle information will make a huge difference. It happened to me a lot. I hope you will learn something from this class, and all the best. Let's start. The method of learning I choose here is based on the first principle thinking, or you can say learning from the scratch. This means understanding all the elements which make up an option chain. With that in mind, try to interpret the stories the option chain is telling through the numbers. So let's begin. Where can we find the option chain? With our friend Google on our side, it is not that hard to find available option chains on any assets. You will have to put in the right keyword and hit the search button. Usually, a search with keyword asset name plus option chain will give us direct link to the web page. For example, if we are looking for Nifty or Banknifty option chain, the keyword will be simply Nifty option chain or Banknifty option chain. Even in the other global indices, this method would yield result. But in certain index funds, finding it can be little tricky. But as I said before, most market offers option chain data at free of cost. Delay in reported numbers is a problem. Still, at large, most market offers with reporting delay limited to 1 to 3 minutes. Now let's look at the basic form of option chain. Around the globe, all the exchanges have adopted nearly the same tabular form of reporting option chain. There are minor changes to reporting format, but overall, the elements reported are the same. Two commonly seen reporting formats are listing and straddle. In listing method, options of same expiry are listed as long vertical table. You can check this. In, in straddle, both call option contracts and put option contracts are given side by side. In general, this format is most commonly used. Now let's discuss the variables or the values reported in an option chain. Though reporting format may change, the values reported are common to both formats. These variables are underlying asset or index, contract, last traded time, strike, last price or last traded price, bid ask quantity and price, price change, change in percentage, volume, open interest, and implied volatility. We will go through these in detail in the upcoming session. You can check the chapters available in the timestamp below to view a specific particular to be explained. Also, one thing to mention is along with this, usually in the money calls and in the money puts will be highlighted with same colors. It is commonly seen on all option chains. Now that you have seen the basic format, let's dive deep into each element in the basic format. For this explanation, I'm choosing option chains available at the NSE website as the example to explain further. This format shown is a straddle format of option chain. National Stock Exchange or NSE is one of the foremost exchanges in India. There will be a common head where it states it is option chain that you are seeing. Then the next thing you will be noticing is a selection criteria asking for which asset you want to see the option chain for. In NSE you have index choice, also script choice separately shown. It is not uncommon to see them together in other markets. Then there will be a selection choice for expiry, or in a different method you can also see option chain on a calendar spread basis for selected strike. For most we use expiry based option chain. Below that you will find reporting values starting from call side, open interest, change in open interest, volume, implied volatility, last traded price, change in price, quantity, bid price, ask quantity, ask price, then strike. Now this all will be repeated on the put side. Now let's see how we are finding out the values related to a particular option. See, if you want to choose 17,000 strike, then on the left side of 17,000 strike line, you will find all the details regarding 17,000 call option. On the right hand side, you will see details regarding 17,000 put option. From here on, we are going to explain about each variables in an option chain in detail. Underlying asset or index. As one knows, option is a derivative instrument. All derivative instruments derive value from the underlying. These underlying can be a stock or an index. In option chain, underlying asset or index means which asset the reported options belong to, or in a much simpler way, from which asset the reported options below are derived. Once you select the underlying, first criteria is selected. On the NSE website, selection for index and stock are separately shown, as option chain is also available for stock. Option chain can be seen for all future and option enabled products. Selection of stock is done under symbol. Now let's talk about the next criteria which we must select to see option. Here we are offered two choices. We can go with expiry or strike. Let's first look into expiry based option chain, then go for the strike based one. As you know, options are contract. They have a specific lifetime. The expiry means the day on which the options becomes exercisable. Beyond that date, options have no power to be in the market. So expiry act like a validity check on available option, and it is based on this expiry date traders and investors build their trade strategies and hedges. Usually this is reported as a list of available expiries. Most time it's a drop down list. From this list, you can choose the particular expiry you want to check the option off. This means once you selected the particular expiry, all strikes of the same expiry will be shown as an option chain. Once that is listed, you can do your further analysis on the option chain. Option chain based on strike. I would call this calendar spread option chain. Here you can choose a particular strike and its value will be reported in all available expiries. You can choose to go with either expiry or strike price for listing of options depending upon your specific requirement. As far as I understood, strike based option chains are most useful when you are looking for a specific price point decision, while expiry based option chains focus more on directional cues. This class will concentrate more on expiry based option chain, and strike based option chain will be used as an additional analytical tool. Options are Options are standardized contracts with specific lot size and exercise prices. Lot size will be the same for all contracts. Also, the exercise price will follow a specific gap rule. This will be commonly applied to all available options for current and future expiries as well. For example, in Banknifty index, the gap followed between the two strikes are 100 points. This means after 38,000 call, you will find 38,100 call, not 38,050 call or 38,000. Now, now let's look into open interest. Out of all the aspects of option chain analysis, understanding open interest is the foremost important thing to learn. You can see an earlier small session I posted on explaining open interest in the description, but to make this class serve its purpose, we must understand it in its essence. So what is open interest? Options are essentially derivative contracts. Open interest means number of active contracts existing in the market. Now let's first try to understand it in a technical way. Afterwards we can go for the layman explanation. Open interest means the total number of contracts still outstanding. It is the sum total of all long position, or equivalently it is the sum total of all short position that has not exercised, closed or expired. Let's try to iterate open interest in a market scenario. In this table, you can see three columns. In the first column, you can see the date. In the second column, it explains what trading activity taken place in the market. In the last column, it is the number of open interest. We will discuss it with an explanation on what happens to open interest based on the trading activity carried out in the market. In this example, A, B, C, D, and E are market participants like option buyers and sellers. On day 1, when the option contracts are introduced into market, open interest is 0. As and when the first transaction is taken place, here when A buys and B sells one option contract, the open interest becomes 1. On day 2, when C, another market participant, buys and D sells 4 contracts, then open interest becomes 5. The 4 new contracts created are added to the existing number of active contracts. Thus, open interest becomes 1 plus 4 new contracts equals 5. On day 3, A sells and D buys one option contract. Here, A had a buy position and it is closed with a sell position. D had a sell position and it is closed with a buy position. Thus, one contracts get closed. So, open interest drops one count. From existing 5 open contracts, we must reduce the number of contracts closed. Here it is 1, thus we get 5 existing contracts minus 1 equal 4. That means right now in market there are 4 contracts are active. On day 4, E buys and C sells 3 contracts. Here the participant E have no previous positions in options, while C had bought 4 option contracts on day 2. So when E buys and C sells 3 contracts, a new position is created with E and C's buy positions are closed with sell to E. No new contracts are created here. Mere transfer of contract is taken place. This means there is no change to open interest. Thus, open interest remains like day 3 at open interest summary so far. So from the earlier slide, we can summarize the following. When a contract is created, it is counted as an open interest. When contract is transacted between buyers, it will not impact open interest. When the initial seller buys the contract, then open interest will be reduced. In essence, transaction between option sellers and option buyers increase or decrease open interest. The transaction between option buyers will not impact open interest count. Now, let's try to understand open interest in a much simpler explanation. In this part, I am adding volume concepts together because the nuanced difference between both can be understood easily in the example. Imagine there is an empty basket and a tray with 12 eggs in it. The empty basket represents the market, while egg represents the contracts and tray represents negotiations. Now you moved 4 eggs into the basket from the tray. And this means volume is 4 and open interest is 4. Now you moved 2 eggs back into the tray from the basket. Now volume is 6, open interest is 2. Then you move 2 eggs inside the basket once. Now volume is 8, open interest is 2. Thus volume will be counted based on the transaction, or as in the example, it will be counted for every move, whether inside the basket or traveling back and forth between tray and the basket. But in open interest, only eggs in the baskets are counted as they are the active. Open interest means number of active contracts in the market when the option chain is reported. To easy understanding, think open interest as cash flow in and out of the market. As open interest increases, more cash is flowing into the market, while decreasing open interest means more cash is flowing out of the market. Increasing open interest typically means a trend is strengthening, while losing open interest means a trend is slowing down. The idea is that traders are supporting the trend by entering the market. This increases open interest. As traders lose faith in the trend, they exit the market, then open interest declines. Open interest is one variable that many future traders use in their analysis of market, use it in conjunction with other analysis to support their trading decisions. Large changes in open interest can be an indicator when certain participants are entering or leaving the market and may give us clues to the market direction. And I repeat, this is one of the most important idea of option chain analysis. Large changes in open interest can be an indicator when certain participants are entering or leaving the market and may give us clues to the open interest behaves in different way in options than it behaves in stock futures and index futures. Since we went this deep, let's dive a little deeper and understand the implication of changes to open interest in stock futures and index futures before we explain this variable specific to option chain analysis, since there is a day and night difference between the two. So this explanation is only for stock futures and index futures, not for options or option chains. You can see a table down below, and I'm going to explain with that. In the first column, it is asset. It could be any stock future or index future. In second column, what is happening to the price for the day is given. In third column, what is the trend of the asset for the last 1 month or 3 months is shown. In the fourth column, what is happening to open interest is given. In fifth column, a Q, or what may happen because of these changes are shown. In a situation where price is rising in an already uptrending market and you are seeing increasing open interest, this can be a sign of another bullish run. And if open interest is decreasing in this situation, this can be a sign of market topping up or upcoming bearish run. Where price is already in a downtrend and falling, along with this you are seeing increased open interest, this can be a sign of another bearish run starting. In such situation, if you are seeing open interest decreasing, then the market is bottoming up, or in some cases it can be the start of a fresh fall. Panic selling can be confirmed with situation where the price is falling from the market top. Along with this, you may see drastic. The next variable reported in option chain are change in open interest or change in OI. As the head says, change to open interest is noted here. As per my experience in dealing with option chain, this is the single most important variable to look for. Any change in OI can direct us towards cues that will help us determine market direction in the upcoming session. This information is valuable in multi-fold as a trader. Volume. The idea of volume is already explained, but let's go through it again. While open interest counts the number of active contracts, volume counts all the transactions that happened in a particular option for the day. Generally, securities with more daily volume are more liquid than those without, since they are more active. Volume is an important indicator in technical analysis because it is used to measure the relative significance of a market move and the instrument. The next variable reported is IV or implied volatility. When we use the term volatility, it often refers to historical volatility, and we do not always say historical volatility as it is assumed to be historical volatility when volatility is mentioned as a single term. Implied volatility is volatility of future, or it is expected future volatility. It is even funnier how IV is calculated. You must have heard about BSM of option pricing or Black-Scholes method of option pricing. This BSM option pricing has volatility as one of the variables in the equation. Now we get the price of options in the market by play of demand and supply. We have price. Now we can reverse apply the price in the equation to find the variables in the equation, provided we know all other variables than volatility. To make it even simpler, suppose x plus y equal to 5, and we know y equal to 2, and then we can easily arrive at x equal to 5 minus 2 equal to 3. Here in layman terms, 5 being the option price and y being the known variables in BSM and x being the volatility. So practically we arrived at volatility value which is of future. This future volatility is known as implied volatility. Generally, implied volatility is market forecast of a likely movement in a security's price. IV is often used to price option contracts where high implied volatility result in option price with higher premiums and vice versa. Supply and demand and time value are major determining factors for calculating implied volatility. Implied volatility usually increases in bearish market and decreases in bullish market. This is due to the left skew or fat tail nature of the stock market. We will discuss this in detail in another video. Finally, IV is purely price based. The next variable reported in option chain are LTP and change. LTP means last traded price or last price. Last traded price means the price of the last trade based on the time when option chain was updated. This often is different from live market, as most time option chains are reported with a delay, maybe 1 to 3 minutes. This can be different for live feed option chains. Change. Now let's look into change. Change means how much the price of the option strike have changed. Now let's discuss about bid and ask quantity and price. First let's look at a table below. Bid quantity and bid price, and ask quantity, ask price. This will be the nature it will be reported, and bidders are known as buyers. End of the day, askers are sellers. Bid quantity means the quantity the buyers are willing to buy, and bid price is the price at which they are willing to buy that quantity. Ask quantity means the quantity sellers are willing to sell, and ask price is the price at which they are willing to sell that quantity. A bid ask spread is the difference between the highest price that buyers is willing to pay for an asset and the lowest price that sellers is willing to accept. The spread is the transaction cost, and price takers buy at asking price and sell at bid price, but the market maker buys at bid price and sell at asking price. We will learn about this market making in another class, as a specialist market maker liquidity provider's role in the stock market must discuss it in detail. Coming back to bid ask, now let's put this into a real life example, like how it plays out in our decision making. An option has bid price 9 and ask price 12, and then the spread is 12 minus 9 equal to 3. Another option has bid 10 and ask price 14, and the spread is 14 minus 10 equal to 4. In this, we should go for the first option, one with the lower spread, because tighter the spread, the better. Tighten the spread, better the liquidity in that particular asset. The bid represents the demand for an asset, and the ask represents the supply for that asset. The bid ask spread is the de facto measure of the market liquidity. As more liquid an asset is, the tighter or lower the spread becomes. And to be frank, I never gave much importance to the bid ask spread reported in option chains, especially in delayed option chains like Nifty and Banknifty. Rather, when I'm interested in a specific strike option, be it put or call, I usually see the market order depth in the watch list of the trading interface, as they are more accurate. Now Now that we have went through all the variables that make up the option chains, let's get to the core of option chain analysis. The first method of option chain analysis we are going to do is on the expiry based straddle option chain. Or to be more precise, the option chain we usually see in Nifty and Banknifty. Option chain can be analyzed on different variables reported in the option chain, but let's focus on open interest and change in open interest. Here, you must understand one thing. I'm very skewed towards open interest data as I have seen more success cues from analyzing open interest data than any other variable reported in option chain. This simply means from here on, what you are going to hear is very biased on my convictions of option chain. Let's break down the option chain reported in the straddle method into four sectors. On the left side we have call in the money and call out of the money. On the right side we have put out of the money and put in the money. We will name call in the money this much portion as 1, put out of the money this much as 2, call out of the money this as 3, and put in the money as 4. Now it would be great if you take a paper and made a similar table. It doesn't have to be perfect, but the core format should be there. One reason for directing as such is I have seen students pick the ideas faster when they interact along. Your table should look something like this. Now each of these sectors can be analyzed alone as well as together. First, let's start with each section alone. Once we understood that, then we can move to analyzing them together. Imagine this is the option chain. Obviously it's a format, and here we have the support line. We named this area as 1 and it belongs to ITM call option. From the strikes here, we are going to check what is happening to each in the money strikes call options open interest. So here we go. If we are seeing open interest increasing, we can have two impending situations. Market is stagnating and a downside can be expected. If you are seeing OI decreasing, market is trying to test new heights or an upside can be expected. Area 2 represents out of the money put option, and here if you are seeing OI increasing, we can conclude market is bottoming up. It's building a strong base. Chances of market going down from here is very small or thin. An upside can also be expected. If you are seeing OI decreasing here, market is trying to test new downside. Also the chance of market going down is now increased. A downside can be expected in near future. Area 3 represents out of the money call option, and here if you are seeing OI increasing, we can conclude market is not seeing an upside in near future. Market is expected to remain at spot or right downside can be expected. And if you are seeing OI decreasing, market is trying to test new heights and upside can be expected very soon. Area 4 represents in the money put option, and here if you are seeing open interest increasing, then we can conclude market is expected to make a new high and an upside can be expected. And if you are seeing open interest decreasing, then we can conclude market is expected to make a new low. Before we go on analyzing open interest further, let's discuss another important aspect of concentrating on open interest count. This can be called the vested interest of option sellers. See, option sellers have significant influence in controlling the market direction in the short term. So finding out what they think is a good idea to know where the market is skewed towards in the short run. To find out the vested interest of option sellers in a single option, you can follow these steps. Find out the margin requirement for selling an option, be it put or call. Let's call this value A. Now count the open interest in that particular option and let's call this value B. Now multiply A into B and you will arrive at let's call this value C, and C is the vested value of option sellers in that particular option. More value they put in one option, the more likely the option expire worthless. So the key is to trying to find out the strikes where the vested interest of option sellers is minimal, and also you can look for which options where option sellers are leaving the market by closing their open position. But note that it must be done across the strikes within a range of 10 strikes up and 10 strikes down, not more than that. Considering deep out of the money options will distort the findings and giving false positives. Open interest combo analysis. These are the common combination of changes in open interest seen together. In all area 1, 2, 3 and 4, if open interest keep on increasing, then we can expect the market Q is flat market or far volatile. And like in long run it can be volatile, but in the short run it be flat. And if in all areas if the open interest is decreasing, then it's a flat market with same like that and for volatile. Like in the short run the market is not going anywhere, and people are losing interest in the market. That is one thing. So there will be it can be a liquid market, so it be flat mostly with a skew to a downside, and it is also called far volatile. Like in long run it can be market can be volatile, but in short run it will stay flat with a skew to downside. And if in area 1 the open interest is increasing, and in area 2 open interest is decreasing, and area 3 again open interest is increasing, and in area 4 again open interest is decreasing, this can be a sign of a confident downtrend. And if in area 1 the open interest is decreasing, in area 2 it's increasing, in area 3 it is decreasing, and in area 4 it is increasing, then it's a confident uptrend. Then in area 4 in area 1, 2, 3 it will be the open interest will be increasing. In area 4 the open interest will be decreasing. This can be a market correction on downside. And if in area 1 and 2 the open interest is increasing, and in area 3 and 4 the open interest is decreasing, this can be a indifferent. This usually happens when a regulatory change is about to happen. Like nobody knows what will happen after the regulatory move. And in if the open interest is increasing on area 1, 2 and 4 and decreasing on 3, then it can be market correction on the upside. These two this is not a confident move, but it can be expected at times. And if the area 1, 2 are decreasing and 3, 4 are increasing, then it can this is also an indifferent market waiting for a regulatory move, but this time it have a skew towards downside. So this is the way we can analyze combination of open interest changes in different areas. I hope you understood. You can take a screenshot of this and you can keep it for reference. For those who are still confused about the volume,
how do you use
volume explanation of the volume along with volume in its simplest form? It means the number of times an instrument traded between 2 points in time. Why it comes to option, the volume consists of volume in each option will help us identify where the market has last expect something to happen. This will give us directional view of the market for a short period, but it's a continuous analysis tool. Hence, its meaning changes with every update. In general, the following can be interpreted from the volume levels. The volume, end of the day, shows the number of instruments traded in the stock market. It usually helps us to identify the trend. Now, let's analyze some of the common situations related to volume. It works not only in option, it works across all the financial instruments. Last traded price drops, but the volume is increasing. This can be a sign of downtrend is strengthening. Last traded price up and the volume is increasing. This can be a sign that uptrend is strengthening. Now, in the opposite way, when a trend is weakening, you can find the following things happening in market. The last price will be up and volume will be low, or last traded price will be down and volume will be low. Decreased volume can also indicate first sign of reverse trend being formed. For those who are still confused about the volume, I'll give you a simple explanation of the volume. And volume in its simplest form, it means the number of times an instrument traded between 2 points in time. When it comes to option, the volume consists of the following: options created, options closed, and existing options traded. Other generic cues from option chain: calls with the highest open interest will act as the resistance, puts with highest open interest will act as the support. This is one of the common interpretation done with the option chain data. Using strike based option chain. After queuing in on expiry based option chain, if you want to specifically create calendar spread strategies or generally know what is expected to market move in coming weeks or months, then you can use strike based option chain to give you a confirmation on directional cues you got from the expiry based option chain. There are other ways to use strike based option chain, but I haven't tried. So once I try it and see any results, I will update here. And that's about it. My knowledge about using strike based option chain is limited. End of the day, what really matters is whether you can make money in the market or not. No matter whatever the analysis you do, if you cannot materialize the knowledge into hard cash, then the whole effort is pointless. The following are some of the guidelines using the information you gathered from option chain. First, do not use option chain alone for interpreting the market. I believe you are not dumb enough to do that. Interpreting option chain will help us learn the vested interest in the market of bigger players. This directional cue, along with the news, technical analysis, or fundamental analysis, will give us a statistical edge and it will make all the difference. I will link you to an older post on option chain analysis. You can read that. But I have updated a couple of things here and there for the video. So what you just saw is the latest one. And I'm concluding the class here. I hope at least some of it made sense. Feel free to comment and thanks for your time.